Why silver is setting new highs. A high-risk market shift. Silver has surged to historic highs, but the price chart only tells part of the story. While financial media celebrates new records, behind this rally is a powerful structural shift driven by AI infrastructure, data centers, and the electrical backbone supporting them. This isn't a speculative bubble. This is industrial demand colliding with supply constraints in a way that hasn't occurred in modern commodity markets. Here's the paradox. Silver production has been essentially flat for a decade, while industrial consumption has accelerated dramatically. Now, as AI data centers proliferate and electrical infrastructure build-out intensifies, demand is suddenly outpacing supply by margins that cannot be closed quickly. And critically, 72% of silver production is a byproduct of copper, zinc, and lead mining, meaning silver supply doesn't respond to silver prices the way conventional models assume. I'm going to show you a pattern so reliable, so mathematically precise, that once you understand it, silver's current move transforms from a price rally into a structural supply crisis. It's called the three-stage critical material shortage cycle, and it explains how technological shifts create demand surges faster than supply systems can adapt. We're watching stage 3 execute right now, strategic scramble and supply lockdown, the phase where industrial buyers and nation-states recognize the shortage is structural and move to secure whatever supply remains. Let me define the mechanism, because understanding this cycle is the only way to comprehend why silver's move isn't about speculation. It's about physics and infrastructure. Stage 1 is technological shift and demand acceleration. A new technology or infrastructure build-out creates exponential demand growth for a material consumed at previously stable rates. The material becomes embedded in critical infrastructure. During this stage, prices may rise modestly, but supply appears adequate because existing inventories mask the acceleration. Market participants assume supply will adjust, as it has historically. Stage 2 is supply constraint recognition and price discovery. As demand acceleration continues, supply systems reveal structural limitations. Mining production cannot scale quickly. New mines require 5 to 10 years. Refining capacity is constrained. Byproduct supply dynamics mean production doesn't respond to price signals normally. Inventories draw down rapidly. Delivery times extend. Industrial buyers experience allocation constraints, not just price increases, but inability to source material. Prices move dramatically because supply cannot meet demand through conventional expansion. Stage 3 is strategic scramble and supply lockdown. Industrial buyers and nation-states recognize the shortage is structural and years long. They shift from price-sensitive purchasing to quantity-focused securing of any available supply. Governments implement export restrictions. Long-term contracts lock in supply at premium prices. The material transitions from commodity pricing to strategic resource allocation. The architects, entities that recognize the shortage early, have already secured supply through vertical integration or long-term contracts. Now, let me prove this pattern with 2 cases where technological shifts created critical material shortages. The first is the rare earth element crisis of 2010-2012. Stage 1 was clean energy and electronics demand acceleration from 2000-2009. Rare earths became critical for wind turbines, EVs, and smartphones. Demand accelerated while China controlled 97% of refining. Supply appeared abundant. Stage 2 was supply constraint recognition in 2009-2010. China implemented export quotas. Rare earth prices spiked. Neodymium went from $20 to over $250. Western manufacturers couldn't source materials in sufficient quantities. The market recognized rare earth supply was geographically concentrated and couldn't be replicated quickly. Stage 3 was the strategic scramble from 2010-2012. Western governments declared rare earths critical and funded domestic mining. Defense contractors secured long-term agreements at premium prices. Companies like Apple began stockpiling and vertically integrating supply chains. But entities that secured supply early in 2009 maintained operations while competitors faced production constraints through 2011-2012. The second case is the semiconductor chip shortage of I-2022. Stage 1 was digital infrastructure acceleration from 2016-2019. Cloud computing, 5G, and automotive electronics created exponential semiconductor demand. Supply appeared adequate as manufacturers expanded incrementally. Stage 2 was supply constraint recognition in 2020-2021. Lead times for chips extended from 12 weeks to 52+ weeks. Automotive manufacturers couldn't source chips for basic vehicle functions. The market recognized semiconductor manufacturing capacity, requiring $10 or $20 billion facilities and 2 or 3 years construction, couldn't scale at demand's pace. Stage 3 was the strategic scramble from 2021-2022. The U.S. CHIPS Act allocated $52 billion for domestic production. Major tech companies like Apple secured dedicated manufacturing capacity through long-term TSMC contracts. Both cases show identical mechanics. Technological infrastructure deployment creates exponential material demand, supply systems cannot scale at required pace, and strategic actors who recognize the pattern early secure supply while others scramble. Now here's why silver's move to historic highs follows this exact pattern. Stage 1 has been AI and data center infrastructure acceleration from 2020 to 2024. AI systems require massive computational infrastructure. Data centers consuming megawatts of power, using silver for conductivity in electrical systems. Each major AI data center represents tons of silver consumption. Simultaneously, solar panel deployment accelerated globally, each panel requiring approximately 20 grams of silver. EV manufacturing scaled to tens of millions of units annually, requiring 25-50 grams of silver per vehicle. This happened while silver mine production remained flat at approximately 820 million ounces annually. Stage 2 is the supply constraint recognition happening now. Silver prices surged to historic highs from industrial buyers discovering supply tightness. Delivery times have extended, physical premiums widened significantly. But here's the critical constraint. 72% of silver is byproduct of copper, zinc, and lead mining. Silver production doesn't respond to silver prices. It responds to copper, zinc, and lead economics. Even if silver doubles, the majority of supply won't increase unless copper mining expands. Primary silver mines represent only 28% of production, requiring 5 to 10 years to bring online. Supply cannot respond at the pace demand is accelerating. Refining capacity adds another constraint. Silver refining is concentrated in Mexico, Peru, China, and Switzerland, operating near capacity. Building new refining capacity requires years and substantial capital. Stage 3 is the strategic scramble beginning now. Industrial buyers in AI infrastructure, solar manufacturing, and EV production are recognizing the shortage is structural and multi-year. They're securing long-term supply contracts. Strategic stockpiling is accelerating. Governments are classifying silver as critical for energy and technology infrastructure. China has implemented strategic metal export restrictions. The tell that sophisticated actors recognized this early. Certain technology companies began securing silver supply chains in 2022-2023 through direct mining investments, long-term offtake agreements, or vertical integration. They recognized AI infrastructure and renewable energy would create demand that supply couldn't meet. By the time prices surged in late 2024, these entities had already locked in supply through multi-year contracts. Let me check the boxes. Has technological shift created exponential demand growth? Yes. AI data centers, solar deployment, and EV production represent structural acceleration. Are supply constraints apparent? Yes. Flat mine production, byproduct dynamics, and refining limits mean supply cannot scale quickly. Are industrial buyers experiencing allocation constraints? Yes. Delivery time extensions indicate quantity shortages, not just price adjustments. Are strategic actors securing supply through contracts? Yes. Reports of major companies signing multi-year offtake agreements. Stage 3 is executing. Here's what mainstream analysis misses. Financial media discusses silver's price move as speculative rally driven by monetary policy or inflation fears. That fundamentally misunderstands what's happening. This isn't speculation, it's industrial demand recognition. The AI infrastructure being built isn't optional. Data centers require electrical systems using silver. Solar panels generating renewable energy require silver that cannot be substituted without efficiency losses. EVs require silver for electrical systems. This demand is structural and non-negotiable. The supply reality is that even with prices at historic highs, production cannot increase substantially in 3 to 5 years. Primary silver mines representing 28% of supply require years to develop. Byproduct supply won't increase unless copper, zinc, and lead mining expands. Refining capacity is constrained. The mathematics show a supply deficit measured in hundreds of millions of ounces. Here's what this means for the next 3 to 5 years. Silver prices will likely continue higher from industrial allocation constraints. Spot market availability may become severely constrained as supply shifts to long-term contracts. Industries dependent on silver, solar manufacturing, electronics production, emerging technologies, may face supply chain disruptions. Entities positioned with secured supply chains will maintain operations, while competitors face constraints. For investors, silver's move isn't a momentum play that reverses when sentiment shifts. It's a structural shortage that won't resolve until demand slows, unlikely given government commitments to AI and renewable infrastructure, or supply expands substantially, which requires years. The risk is underestimating how structural material shortages create sustained price pressures that persist far longer than expected. Pattern recognition beats prediction. And the pattern is clear. Technological infrastructure has created silver demand acceleration that supply systems cannot match. Industrial buyers are scrambling to secure supply, and strategic actors who positioned early maintain advantage while others face allocation constraints. Silver's historic highs aren't a bubble. They're a price discovery reflecting a supply deficit that will persist for years. Understanding critical material shortages as structural rather than speculative determines whether you recognize opportunity or misread the situation as temporary volatility.